Conceptual foundations, assumptions, and rationale behind FIFO and LIFO. What the methods try to do, both FIFO first in first out and LIFO last in first out, are ways to decide which inventory costs become cost of goods sold (COGS) when a company sells items. They do not track the exact physical flow of goods, they are accounting conventions. Assumption of physical flow. FIFO, imagine a grocery store where fresh produce is stocked at the back and older items are pulled from the front. The oldest items leave the shelf first. This mirrors the idea that the first units purchased are the first sold. LIFO, think of a stack of pallets in a warehouse where the newest pallet is placed on top of the stack. When a truck arrives, the top pallet, the most recent purchase, is taken first. This mimics the last units purchased being sold first. Why choose one over the other? Inflationary environment. If prices are rising, FIFO reports higher ending inventory because the newest, more expensive items remain on the books and lower COGS, leading to higher gross profit. LIFO does the opposite. Older cheap costs stay in inventory. Newest expensive costs hit COGS, reducing profit and taxes. Stability. FIFO tends to produce smoother earnings because it reflects the current replacement cost of inventory on the balance sheet. LIFO can cause earnings volatility when purchase prices swing. Underlying accounting assumptions. Both methods assume a perpetual or periodic inventory system, the matching principle, costs matched with revenues, and that inventory is homogeneous enough that the specific unit identity does not matter. A company purchases 100 units of widget A. On January 1st, 40 units at $10 each for $400. On February 15th, 30 units at $12 each for $360. On March 10th, 30 units at $15 each for $450. FIFO calculation. Oldest costs first. Take 40 units at $10 equals $400. Take 30 units at $12 equals $360. Take 10 units at $15 equals $150. Cost of goods sold FIFO equals 400 plus 360 plus 150 equals $910. Ending inventory equals remaining units. 20 units at $15 equals $300. LIFO calculation. Newest costs first. Take 30 units at $15 equals $450. Take 30 units at $12 equals $360. Take 20 units at $10 equals $200. Cost of goods sold LIFO equals 450 plus 360 plus 200 equals $1,010. Ending inventory equals remaining units. 20 units at $10 equals $200. Mathematical expressions. FIFO COGS equals sigma of I equals 1 to k of quantity I times cost I, where I runs from the earliest purchases until the quantity sold is met. LIFO COGS equals sigma of I equals n to m of quantity I times cost I, where I runs from the most recent purchases backward. These simple arithmetic steps illustrate the mechanics behind each method. Income statement. Revenue is unchanged, sales price times units sold. Cost of goods sold differs. FIFO gives lower cost of goods sold when prices rise, boosting gross profit, operating income, and net income. LIFO yields higher cost of goods sold, reducing those profit figures. Example using numbers above. Sales price $20 per unit. Sales equals 80 times $20 equals $1,600. Gross profit under FIFO equals $1,600 minus $910 equals $690. Gross profit under LIFO equals $1,600 minus $1,010 equals $590. Net income follows the same pattern after deducting other expenses. Balance sheet. Inventory appears under current assets. FIFO reports a higher inventory value, $300 versus $200, because it leaves the most recent expensive units on the books. Retained earnings reflects cumulative net income. Thus, FIFO-derived earnings increase retained earnings, while LIFO-derived earnings lower them. Presentation differences. The same physical inventory can generate two different equity positions solely due to the costing method. Investors must read the footnotes to understand which method is used, and may need to adjust comparisons across firms. Visualization analogy. Picture 2 jars of marbles. One jar labeled FIFO contains mostly bright new marbles, high cost, left over, while the LIFO jar holds dull, older marbles, low cost. The jar's visual value balance sheet inventory looks higher for FIFO. U.S. tax law permits the LIFO method for income tax reporting, provided it is also used for financial reporting, or a LIFO reserve reconciliation is disclosed. LIFO reserve. The difference between inventory reported under FIFO, required for IFRS and often shown for comparability, and under LIFO. Formula: LIFO reserve equals inventory FIFO minus inventory LIFO. In the example above, reserve equals $300 minus $200 equals $100. Deferred tax asset or liability. Because FIFO inventory is higher, taxable income is higher, leading to higher current tax expense. The LIFO reserve creates a temporary timing difference. The tax effect of the reserve is recorded as a deferred tax liability if LIFO results in lower taxable income, or an asset if the opposite. Tax payment effect. Using LIFO in an inflationary period can defer tax cash outflows because taxable income is reduced. The company keeps cash longer, which can be used for operations or investment. Transition considerations. Switching from FIFO to LIFO or vice versa requires filing Form 970 LIFO to FIFO with the IRS and adjusting the LIFO reserve. The cumulative effect is recognized in retained earnings. International context. Most countries under IFRS forbid LIFO for financial reporting, so multinational firms using LIFO in the United States must maintain a parallel FIFO book for consolidation, adding complexity and tax planning opportunities. Explanation: effects on key financial ratios, performance metrics, and decision-making. Current ratio: current assets divided by current liabilities. Under FIFO and inflation, higher inventory leads to higher current assets and thus a higher ratio. Under LIFO, lower inventory leads to a lower ratio. Quick ratio, which excludes inventory, remains unchanged under both FIFO and LIFO, because inventory is removed from the calculation. Gross margin percent equals sales minus cost of goods sold divided by sales. Under FIFO, gross margin is higher because cost of goods sold is lower. Under LIFO, gross margin is lower. Inventory turnover equals cost of goods sold divided by average inventory. Under FIFO, turnover is lower because cost of goods sold is lower and inventory is higher. Under LIFO, turnover is higher. Days sales of inventory equals 365 divided by inventory turnover. Under FIFO, days sales of inventory is higher, indicating more days to sell. Under LIFO, it is lower. Return on assets equals net income divided by average assets. Under FIFO, both net income and assets are higher, but the net income effect usually dominates, leading to a higher return on assets. Under LIFO, return on assets is lower. Earnings per share is higher under FIFO and lower under LIFO. Management decision-making. A firm may prefer FIFO when it wants to showcase strong profitability to attract investors or secure credit, while LIFO can be used strategically for cash flow management and tax deferral. Operational decisions. Because LIFO shows a higher inventory turnover, managers might be motivated to push for faster sales or tighter inventory control, even though this metric is a byproduct of the accounting choice rather than real efficiency. Analyst adjustments. Financial analysts often recalculate ratios using a common method, usually FIFO, to compare firms on an apples-to-apples basis. FIFO advantages. Reflects current replacement cost on the balance sheet, useful for lenders assessing collateral. Higher reported earnings in inflationary periods, which can improve market perception. International compatibility, required under IFRS, eliminating the need for dual books. FIFO disadvantages. Higher tax liability because taxable income is higher. Potential overstatement of profit if old cheap costs are not representative of current economic conditions. LIFO advantages. Tax deferral, lower taxable income when prices rise, freeing cash. Matches recent costs with current revenues, arguably providing a better matching of cost revenue. Lower reported inventory can signal efficient inventory management to some stakeholders. LIFO disadvantages. Not permitted under IFRS, multinational firms must keep parallel FIFO books, increasing complexity. Balance sheet inventory may be unrealistically low, potentially affecting loan covenants that rely on asset levels. LIFO liquidations selling older cheap inventory can cause spikes in taxable income in later periods. When to use which method? Highly inflationary economy, domestic U.S. company tax sensitive, LIFO. Company with significant foreign operations needs IFRS compliance, values clean balance sheet values, FIFO. Commodity-intensive business where inventory cost changes rapidly, often adopts LIFO for tax benefits. Retail with perishable goods, FIFO mimics the physical flow, old stock sold first and avoids spoilage. Decision tree analogy. Choose FIFO if you want the picture of the inventory to look fresh and valuable. Choose LIFO if you want to keep more cash in the pocket now. IFRS versus US GAAP treatment of first in first out and last in first out, and implications for multinational reporting. Only FIFO and weighted average are allowed for inventory measurement. LIFO is expressly prohibited, IAS 2. Requirement: inventory must be measured at the lower of cost and net realizable value, NRV. Both FIFO and LIFO are permitted, ASU 2015-16. Companies can elect LIFO if they want tax benefits. Inventory measured at lower of cost or market, LCM, where market is a midpoint of replacement cost, NRV, and net realizable value. Implications for a multinational corporation. Dual reporting, U.S. subsidiary may use LIFO for tax. The consolidated financial statements, IFRS, must restate inventory to FIFO, creating a LIFO reserve. Systems complexity. ERP systems must track two cost layers, one for tax, one for reporting. Currency translation. The LIFO reserve is also subject to foreign exchange fluctuations, affecting deferred tax calculations. Investor perception. Analysts in Europe will view higher FIFO-based profits. U.S. analysts may adjust for LIFO effects. Practical example. A U.S.-based electronics maker with plants in Mexico uses LIFO domestically to reduce U.S. taxes, but reports FIFO for the Mexican operation. The consolidated statements show a $5 million LIFO reserve, which is disclosed in the footnotes, and used to compute a deferred tax liability at the corporate tax rate. Strategic takeaway. Companies must weigh the cost of maintaining parallel inventories against the tax savings of LIFO. Many opt for FIFO globally and keep LIFO only for the U.S. tax return. Explanation: exam-style questions, sample calculations, and model answers on FIFO versus LIFO. Number 1. Multiple choice: Question: a company bought 100 units at $5, 150 units at $7, and 200 units at $9. It sold 250 units during the period. Under LIFO, what is the cost of goods sold? Options: A. $1,750, B. $1,850, C. $1,950, D. $2,050. Answer and explanation: use newest costs first: 200 times $9 equals $1,800. Remaining 50 times $7 equals $350. Cost of goods sold equals $1,800 plus $350 equals $2,150. Not listed. Check math: actually 200 times $9 equals $1,800. 50 times $7 equals $350, total $2,150. None match, so the closest is D, $2,050, typo in options. A real exam would have the correct option. This illustrates the process. Number 2. Computation: Scenario: beginning inventory 40 units at $12. Purchases: 60 units at $15, 80 units at $18. Sales: 130 units. Task: compute FIFO, cost of goods sold and ending inventory. Solution: FIFO cost of goods sold: 40 times $12 equals $480, 60 times $15 equals $900, 30 times $18 equals $540, only 30 of the 80 needed. Total equals $1,920. Ending inventory: remaining 50 units at $18 equals $900. Number 3. Short answer: Question: explain why LIFO may lead to a higher inventory turnover ratio than FIFO. Model answer: inventory turnover equals cost of goods sold divided by average inventory. Under LIFO, cost of goods sold includes the most recent higher purchase costs, increasing the numerator, while ending inventory consists of older lower cost items, reducing the denominator. Hence the ratio appears higher even though physical sales volume is unchanged. Number 4. Essay: Prompt: discuss the tax advantages of LIFO and the potential risks associated with LIFO liquidation. Key points to include: tax deferral in inflationary periods, cash flow benefit. LIFO reserve and deferred tax liability. LIFO liquidation occurs when older, cheaper inventory is sold, causing cost of goods sold to drop and taxable income to jump, possibly leading to a tax shock. Management should monitor inventory layers to avoid unexpected tax spikes. Sensitivity analysis: how changes in purchase prices influence FIFO and LIFO outcomes. Setup: assume a company purchases 3 batches of 100 units each. Batch 1 $10 per unit, batch 2 $12 per unit, batch 3 $14 per unit. Sales equal 200 units. Base case results: FIFO cost of goods sold equals 100 times $10 plus 100 times $12 equals $2,200. LIFO cost of goods sold equals 100 times $14 plus 100 times $12 equals $2,600. Sensitivity test: increase each purchase price by 5%, inflation shock. New costs: $10.50, $12.60, $14.70. FIFO cost of goods sold new equals 100 times $10.50 plus 100 times $12.60 equals $2,310, 5% increase. LIFO cost of goods sold new equals 100 times $14.70 plus 100 times $12.60 equals $2,730, 5% increase. Observation: both methods increase proportionally when all layers rise uniformly. The differential, LIFO minus FIFO, remains $400 in both cases because the spread between the oldest and newest layers stays constant. Non-uniform price change: suppose only the newest batch jumps to $20 per unit, approximately 43% rise, while older batches stay the same. FIFO cost of goods sold unchanged equals $2,200. LIFO cost of goods sold equals 100 times $20 plus 100 times $12 equals $3,200, an increase of $600. The gap widens, showing LIFO is more sensitive to price spikes in recent purchases. Graphical illustration: plot cost of goods sold on the y-axis versus price of newest batch on the x-axis. FIFO line is flat, unchanged, until the price of the oldest batch changes. LIFO line slopes upward sharply with the newest price. Management implication: firms can simulate scenarios such as commodity price spikes to forecast tax liability and cash flow differences between methods. Sensitivity analysis helps decide whether the tax benefit of LIFO outweighs the possible volatility in reported earnings. Transparency versus manipulation: choosing LIFO solely to lower taxable income can be legitimate, but if a company switches methods frequently to smooth earnings, it may be viewed as earnings management eroding stakeholder trust. Stakeholder impact: investors prefer methods that present true economic performance. Misleading high profits via FIFO in inflationary times may overstate future cash-generating ability. Stakeholder impact: creditors rely on inventory as collateral. Understated inventory LIFO might breach loan covenants, inadvertently causing default. Consistency principle: ethical accounting requires consistent application of the chosen method across periods unless a justified change is disclosed. Sudden switches without justification can be a red flag. Strategic alignment. A firm with a long-term plan to expand internationally may adopt FIFO to align with IFRS, simplifying consolidation and avoiding the administrative burden of LIFO reserves. Corporate social responsibility. In perishable goods industries, FIFO mirrors the actual physical flow, reducing waste and supporting sustainability claims. Regulatory compliance. In the United States, the IRS mandates that if LIFO is used for tax, it must be used for financial reporting unless a LIFO reserve disclosure is made. Ignoring this rule is illegal. Decision-making checklist item. Does the method reflect the actual flow of goods? Decision-making checklist item. What are the tax advantages versus the cost of maintaining dual inventories? Decision-making checklist item. How will the choice affect covenant compliance and stakeholder perception? Decision-making checklist item. Is the method allowed in all jurisdictions where the company operates? Bottom line, selecting FIFO or LIFO is not just a number-crunching exercise.